Right. Now that you're calling for greater consistency in regulation across the board, and we have specific instances of regulatory failure, what do you expect to come out of the Financial Stability Board initiative that the G20 is trying to put together? What do you think are the key initiatives that we need to keep our fingers on, and what should we not lose in the process?
Well, I think there are two things that are very important in the Financial Stability Board. I was a member of the Financial Stability Forum, its predecessor, from 2003 until last year. So I've seen it evolve, and I believe that one element which is very important is the expansion of membership in the Financial Stability Forum or Financial Stability Board. I think that if we're going to have globally consistent regulation, and I really hope that that's what we will have, because that has the best chance of mitigating the risk of a future major global crisis, that the FSB will play a very central role in that, and it will be a process whereby the best ideas are put forward and there's a buy-in by the other countries. And that does not necessarily mean that it will just be the home supervisors of the largest institutions that have a role. Beyond that, the FSB has been very proactive, starting with the report that I was involved in that we put out in March, April of 2008 on the immediate steps that needed to be taken to address the financial turbulence. But moving into, for example, principles of compensation and so on, which actually draw on earlier work by the Institute of International Finance, but which I think take the situation forward. The bottom line is that we have a financial system which will innovate, which will, where if there are gaps, there will be regulatory arbitrage. Firms will have an incentive to take advantage of that. And therefore the FSB is the place where those areas which are clearly market failures, information asymmetries or weaknesses in the way firms perceive systemic risk, can be resolved, hopefully in a way that all the regulators will adopt.
Would you say that the FSB's initial culture in terms of the mix of ministers of finance as well as regulators is something that might actually dilute what it's able to achieve? And do you think there's too much focus in terms of getting global credit moving at the moment, and a lot of the initiatives will be focused on that front rather than anything else?
Well, two separate questions there, of course. First of all, in the FSB, it's not just the regulators and the finance ministers, is also the central banks.
Okay.
And a lot of the central banks are not the regulators. So in many countries, there are 3 people represented at the table when the FSB meets. I think this is crucially important, frankly, because when you think about macro-prudential regulation and supervision, it is a triad or a quadrilateral, in that the Ministry of Finance is normally the institution that establishes the legal framework under which the financial system operates, often with advice from the central bank. You have the supervisory agency, which does the microprudential supervision, and it determines whether the institutions are sound. You have a central bank, which is the lender of last resort, and if it is also the supervisor, it has an institutional conflict of interest, I think, potentially, between its lender of last resort function and its supervisory function.
Right.
So I think that having those agencies, all 3 of them together, will be absolutely essential to achieving global consistency of financial regulation.
Yeah.
Then on the question of getting credit moving again, this is a very tricky one. You know, obviously the idea that capital adequacy needs to be enhanced, it runs against the idea of restarting credit growth very rapidly. We've seen a better tone in the credit markets this past quarter, the first quarter of 2009, than we'd seen in the whole of 2008, not just in the final quarter. But I think that is largely refinancing or rollover financing by the best quality corporations, and in the United States, some prime mortgage borrowers. But this does not reflect underlying investment credit for investment and credit growth that will sustain growth of GDP. Right. And frankly, I think one of the issues here is that because demand is weak, inventory investment is, of course, declined very substantially. Fixed capital formation is very low. Loan demand is weak. Now, these are conditions where, particularly since virtually all central banks have brought policy interest rates down to very low levels, we have relatively steep yield curves, and that will help financial institutions earn their way out of the capital deficiencies that they have over time.